Welcome back to the Explainer. Okay, today we are unpacking one of the most absolutely stunning financial milestones we've seen in recent global banking history. If you follow global finance, you understand that shifting macroeconomic tectonic plates can literally crush an institution, or they can launch it to completely new heights. Well, today we're looking at a bank that didn't just survive a massive policy shift, they fundamentally transformed themselves to catch the wave. So here's the central question we're tackling today. How exactly did Mitsubishi UFJ Financial Group, or MUFG for short, navigate the definitive end of Japan's negative interest rate era to post a record-high net income for the third consecutive year? It's a fascinating story of macroeconomics, major structural pivots, and a massive technological leap, all culminating in a truly historic bottom line.
And when I say historic, I mean a net income of 2,427.2 billion yen for the fiscal year that ended in March 2026. Yes, you heard that right. That represents a massive 31% surge over the previous year. It's the kind of figure that absolutely demands we take a deep dive into the engine room of Japan's largest financial institution to figure out exactly what's driving all this growth.
Here is our roadmap for today. We'll start with the milestone itself, then unpack the macro wins of rates and FX, examine structural engines like the Morgan Stanley partnership, look at their AI-native pivot, capital returns, and finally, wrap up by assessing future risks. All right, let's jump straight into segment 1, the 2.4 trillion yen milestone. This historic bottom line isn't just an accident. It's the direct culmination of MUFG's medium-term business plan. Looking at the consolidated financial results here, that robust net operating profit of 2,377.2 billion yen is honestly the clearest signal yet that their structural transformation is really working. It reflects higher net interest income, much better margins, and a highly successful recovery from their previous bond rebalancing efforts. But if you want the real metric that proves they've unlocked new value, look at their return on equity, or ROE. MUFG reached an ROE of 11.3%. This is absolutely crucial because it brings the group well within striking distance of its upwardly revised 12% target. Essentially, it proves they can actually generate much higher returns on the massive amount of capital they deploy. Moving on to segment 2, macro wins, rates, and FX. Now, you really can't decouple these record profits from historic policy changes in Japan. There's this fascinating tug-of-war taking place right on their balance sheet. On one side, Japanese yen interest rate hikes handed them a massive 170 billion yen boost to the bottom line, simply because the bank could pass higher charges to customers. But on the flip side, persistent inflation and rising base expenses created an 80 billion yen drag. So what's the key takeaway here? The rate hikes comfortably overpowered the inflationary costs. And then, of course, there's the currency windfall. Foreign exchange fluctuations were another huge driver of gross profits, contributing roughly 200 billion yen. This was driven by the US dollar to yen rate climbing from 149.52 at the end of FY24 all the way up to 159.88 by March 2026. As we know, a weaker yen historically acts as a massive tailwind for Japanese megabanks with large global footprints. Of course, global politics act as major macroeconomic variables here. An S&P Global analyst noted that the Bank of Japan will likely continue its rate hike cycle, quote, unless a clear risk emerges regarding U.S. tariff policy under President Trump and whether that actually becomes a drag on the Japanese economy. So management is carefully tracking these international policy shifts as they map out their forward guidance. All right, segment 3, the Morgan Stanley engine. Now, beyond the macro stuff, UFG's record profits were heavily fortified by the structural engines within its diversified business model. Let's be clear, this is not just a traditional Japanese lender anymore. It is a global machine. The Morgan Stanley stake alone contributed a staggering 676.4 billion yen to net income. Meanwhile, the global market segment saw this dramatic turnaround, swinging back to a 57.7 billion yen profit after a massive loss the previous year. We're talking about a recovery of over 700 billion yen year over year. And on top of that, core customer segments grow by 16%, which shows deepened client relationships and increased lending spreads. Beyond those core segments, the bottom line was further padded by 845.5 billion yen in net gains just from the accelerated sale of cross-shareholdings. They are also aggressively expanding their Asia platform. A great example is their recent investment in Shriram Finance, a major Indian non-banking financial company. Plus, outstanding global loan demand remains incredibly strong across the board for megabanks. Let's pivot to segment 4, AI and digital transformation. So where are they heading next?
Well, MUFG is actively repositioning itself from a traditional financial institution into a truly AI-native organization. And look, this isn't just buzzword marketing. Their strategic alliance with Google is yielding a brand new digital bank opening in FY26. Furthermore, they are completely overhauling their retail financial services, merging Mitsubishi UFJ eSmart Securities with the robo-advisor pioneer Wealth Navi. This is all to create a fully integrated, seamless digital experience under their MU-MUT brand by FY27. Building this across the entire enterprise, they've already implemented 250 distinct AI use cases. They're deploying tools like ChatGPT Enterprise and Copilot left and right. This has completely outpaced their original roadmap and is already yielding a cumulative financial benefit of 30 billion yen. So they have moved far beyond the experimental phase. They are literally baking AI directly into their operational DNA.
Which brings us to segment 5, capital strength and returns.
So what does this highly profitable tech-forward transformation actually mean for the people holding the stock? Well, with their capital cushion expanding, UFG raised their FY25 annual dividend per share to 86 yen, which beat previous forecasts by 12 yen. And they've already confidently set a forecast of 96 yen for FY26. In fact, in their official notice concerning dividends, management targets a payout ratio of approximately 40%. They are making a very clear, documented commitment here to continuously improve shareholder returns, carefully balancing solid equity capital with strategic growth investments. And they are totally backing that up with aggressive capital management. They authorized a 100 billion yen share repurchase program and had already bought back over 21 million shares by late June 2026. Combine that with the upwardly revised 12% ROE target and a highly ambitious FY 2027 net income target of 2.7 trillion yen, and it's crystal clear that management is highly confident in the long-term sustainability of these earnings. But here's the crazy part. Even with these aggressive buybacks and their massive APAC expansions, their regulatory standing remains rock solid. As of late 2025, their Basel III capital ratios showed total capital at 18.68%, Tier 1 at 16.66%, and Common Equity Tier 1 at 1,400%. They are maintaining formidable capital buffers that sit comfortably above regulatory requirements.
Finally, let's look at segment 6, navigating future risks. Look, no analysis is complete without scanning the horizon, especially as MUFG enters the final leg of their business plan. Management is currently tracking a triad of external pressures. First up, geopolitics. Specifically, they identify the Middle East conflict as a primary threat to credit stability and global economic growth. Second, tech vulnerabilities. Their whole AI-native shift brings new technical risks, requiring increased defensive spending against AI-driven fraud and information security threats. And third, market liquidity. They're keeping a very close eye on the private credit market for any signs of declining liquidity or potential turbulence.
Which leaves us with this final, provocative thought. By leveraging the end of negative rates and extracting maximum value from their global partnerships, MUFG has clearly transformed from a traditional lender into a tech-integrated powerhouse. But as inflation, geopolitics, and AI risks loom on the horizon, can this newly streamlined high ROE machine actually weather the coming global uncertainties? It is a fascinating evolution, and I, for one, can't wait to see what they do next. Thank you so much for joining me on this explainer, and keep learning.